London, a city renowned for its power, wealth, and influence. Its skyline is a testament to centuries of financial might, where fortunes are made and lost in the blink of an eye. But beneath its glitzy exterior lies a darker truth. London serves as the epicenter of a global web of illicit wealth. Every year, staggering amounts of dirty money flow through this city, cleverly concealed in plain sight. From corrupt officials to criminal enterprises, London has evolved into the world's money laundering hub. From covert shell companies to opulent real estate holdings, let's take a deep look into the hidden fortune of London's shadowy empire. London's rise as a financial powerhouse is a story of ambition and innovation. From its early days as a bustling port city to its current status as a global financial center, London's journey has been extraordinary. It began in the 17th century, when London's strategic location and robust trade networks laid the foundation for its financial ascendancy. The establishment of the Bank of England in 1694 was a pivotal moment, providing stability and confidence for economic expansion. Throughout the 18th and 19th centuries, the Industrial Revolution fueled unprecedented growth. London's financial institutions evolved to support this expansion, financing everything from railways to factories. By the late 19th century, London was the world's financial capital. The London Stock Exchange, founded in 1801, attracted investments from around the globe. The city's influence continued to grow in the 20th century, despite the upheavals of two world wars. Post-war, London's financial district, known as the City, underwent significant modernization, cementing its role in the global economy. Today, London is home to some of the world's largest banks, insurance companies, and investment firms. Its financial services sector generates billions in revenue and provides thousands of jobs. As London has grown, so too have the complexities and challenges of managing a global financial hub. Amidst the legitimate business, a shadow economy has thrived, exploiting the very systems that have driven London's success. Financial crime is as old as finance itself. London's journey to becoming a financial powerhouse is dotted with scandals that have left enduring imprints on its history. One of the earliest and most infamous cases was the South Sea Bubble of 1720. Promoted as a lucrative investment opportunity, the South Sea Company promised immense returns, but it was a scheme built on speculation and deceit. The bubble burst, leaving countless investors ruined and shaking the very foundations of the financial market. The 19th century saw its own share of financial impropriety. One notable case was the collapse of Over-End Gurney and Company in 1866. Known as the Bankers' Bank, it lent recklessly and failed spectacularly, causing a major financial panic. This was a stark reminder of the dangers of unchecked speculation and poor oversight, highlighting vulnerabilities within London's burgeoning financial sector. As the financial world grew more complex, so did the crimes. The 20th century brought the Great Train Robbery of 1963, a bold heist that captured public imagination. Although not a typical financial crime, it underscored the allure of London's wealth and the lengths to which criminals would go to obtain it. Insider trading scandals also emerged, with cases like that of Guinness in the 1980s. Executives manipulated share prices to inflate the company's value during a takeover bid, leading to high-profile convictions and public outcry. These early cases of financial crime in London reveal a pattern. Where there's money, there's temptation. Each scandal not only exposed the weaknesses in the financial system, but also paved the way for more sophisticated and covert methods of financial crime. Understanding these historical cases is crucial as we take a look at the mechanisms that continue to facilitate dirty money in modern-day London. The city's legacy of financial crime is a backdrop to the intricate and shadowy operations that persist today. London's allure as a financial hub is irresistible, not just to legitimate businesses, but also to those seeking to hide ill-gotten gains. The city's financial infrastructure, its global connections, and its array of high-value assets make it a magnet for dirty money. Money laundering is the process of making illegally gained proceeds appear legal. In London, this process is facilitated by several sophisticated techniques, each designed to obscure the origins of the money and integrate it into the legitimate economy. One common method is through shell companies, businesses that exist only on paper. These entities allow criminals to move large sums of money with minimal scrutiny. Another popular method is investing in high-end real estate. London's property market, with its soaring prices and opaque ownership structures, provides an ideal vehicle for laundering money. Trade-based money laundering is another technique, involving the manipulation of invoices and trade documents to disguise the movement of funds. This method takes advantage of London's position as a global trade hub. Offshore accounts and tax havens also play a crucial role. Money is funneled through a complex web of international accounts, often ending up in London, where it can be invested or spent with little trace of its illicit origins. Cryptocurrency has added a modern twist to these age-old practices. Digital currencies provide anonymity and speed, making it easier for criminals to move large sums without detection. These techniques, while varied, all share a common goal: to integrate dirty money into the legitimate financial system. London's sophisticated financial ecosystem, with its array of services and lack of transparency in certain areas, provides the perfect environment for this integration. Banks and financial institutions are the gatekeepers of the financial system. Their role in preventing money laundering is crucial. Yet, despite stringent regulations, these institutions often find themselves at the center of laundering scandals. Banks are expected to perform due diligence, ensuring that the funds flowing through their systems are clean. However, the sheer volume of transactions and the sophisticated methods employed by money launderers make this a daunting task. One high-profile case was the HSBC money laundering scandal. In 2012, the bank was fined $1.9 billion by US authorities for failing to prevent money laundering by drug cartels and other criminals. HSBC's case was not isolated. Deutsche Bank has also faced numerous allegations and fines for its role in laundering billions of dollars from countries like Russia and other regions. These cases reveal systemic issues within banking institutions: inadequate compliance programs, lack of oversight, and sometimes even willful blindness to suspicious activities. Banks use a variety of tools to detect money laundering, including sophisticated software systems that monitor transactions for unusual patterns. However, these systems are not foolproof and often require human oversight to identify and act on suspicious activities. Additionally, the culture within some financial institutions prioritizes profit over compliance. This pressure can lead employees to overlook red flags in pursuit of lucrative business. Regulatory bodies, such as the Financial Conduct Authority, FCA in the UK, are tasked with overseeing these institutions and enforcing anti-money laundering (AML) regulations. However, the effectiveness of these bodies is often called into question. The financial system in London operates under a complex web of regulations designed to prevent money laundering and financial crime. But despite these efforts, significant loopholes and regulatory failures persist. At the heart of the UK's anti-money laundering framework is the Proceeds of Crime Act 2002 POCA. This legislation provides the legal basis for confiscating the proceeds of crime and mandates reporting suspicious activities. Yet, its effectiveness is often limited by enforcement challenges. The Financial Conduct Authority, FCA, is the main regulatory body overseeing financial institutions in the UK. It sets stringent anti-money laundering, AML, guidelines and conducts regular inspections. However, the sheer scale of London's financial sector makes thorough oversight difficult. A major challenge is the sheer volume of transactions processed daily, which can obscure illicit activities. Banks and financial institutions are required to implement robust AML measures, but the complexity of these systems often leaves gaps. Despite the regulations, certain practices and legal structures continue to facilitate money laundering. One such example is the use of shell companies and offshore entities. These entities can hide the true ownership of assets, making it difficult to trace the origins of funds. Another significant issue is the concept of regulatory arbitrage, where criminals exploit differences in regulatory standards between jurisdictions. London's status as a global financial hub means it is often at the crossroads of such practices. High-profile cases have brought these weaknesses to light. The Russian laundromat scandal revealed how billions of dollars were funneled through London with minimal oversight, exploiting the city's financial infrastructure. Similarly, the Panama Papers leak exposed the extent to which offshore structures were used to conceal wealth and evade scrutiny. Many of these funds found their way into London's economy, highlighting the city's vulnerability to global financial crime. The UK's response has been a mix of tightening regulations and increasing penalties. Initiatives like the Unexplained Wealth Orders, UWOs, empower authorities to investigate suspicious wealth. However, enforcement remains inconsistent. Despite these efforts, the scale and complexity of financial crime in London mean that much work remains to be done. Effective regulation requires not just robust laws, but also diligent enforcement and international cooperation.